What if the money you use every day suddenly stopped being physical?
And when that happens, who actually controls the system behind it? This is not a distant future scenario. It's already happening right now.
Across Europe, a quiet transformation of money is already underway.
It is called the digital euro, and it could redefine how money works.
But this is not a cryptocurrency, and it's not a speculative digital asset. This is still the euro, the same currency people already trust.
But now it is being redesigned for a fully digital financial system. And that redesign introduces a completely new layer of control.
Because money is not just a tool. It defined who holds real power.
Today, most payments no longer happen with physical cash in hand. They move through invisible systems that most people never actually see. And those systems are not always controlled by governments or central banks. Instead, they are dominated by banks, card networks, and private companies.
And increasingly, large technology firms are becoming part of that structure.
This shift is not just technological, it is a shift in financial power. And Europe is beginning to understand the scale of that change.
It is not losing the euro itself, but it is losing control over how it moves.
And control over payments means control over the entire economic flow.
So the response from Europe is not just regulation, it is reconstruction.
So Europe is not just reacting, it is rebuilding the system itself.
Not by replacing banks, but by creating a new layer beneath them.
A public layer of money designed specifically for the digital age. This is where the concept of the digital euro becomes critical.
Because this is not just a payment tool, it is a structural reset.
To understand its impact, we need to look at how this system actually works. At the core, the digital euro would be issued by the central bank.
But unlike traditional systems, it would not be distributed directly.
Banks and payment providers would still handle user access and interaction.
So the existing financial system is not replaced, it is extended. For users, the digital euro would exist inside a secure digital wallet.
This wallet could be provided by banks or authorized payment services. From there, payments would feel familiar, simple, and nearly instantaneous.
You could pay in stores, online, or transfer money directly to another person.
But behind that simplicity, the nature of the money itself is fundamentally different. Because unlike most digital payments today, this would be central bank money.
That means it carries the same level of trust as physical cash.
In simple terms, it is money backed directly by the state, not by a bank.
This allows transactions to move faster with fewer layers in between.
And that structural change is what gives the digital euro its real significance. But the most advanced feature of the digital euro lies beyond speed or convenience.
It is the ability to make payments without any internet connection at all.
Two devices could exchange value directly without relying on external networks.
In many ways, this brings digital payments closer to how physical cash behaves. It combines the resilience of cash with the efficiency of modern technology.
But this is also where the most sensitive questions begin to emerge. What happens to privacy when every transaction becomes fully digital? The answer is more complex than a simple yes or no.
Offline transactions could offer a level of privacy similar to physical cash.
But online transactions would still need to follow strict regulatory rules.
So the digital euro is not designed to be fully anonymous in practice. But it is also not intended to function as a system of total surveillance.
It exists in a carefully designed balance between privacy and regulation.
And maintaining that balance is one of the hardest challenges in its design. But the next risk is not about privacy. It is about the stability of banks.
If people begin to hold large amounts of digital euro, banks could face pressure.
Because that money would move away from traditional bank deposits.
And when deposits decline, bank liquidity can become a serious concern.
In extreme cases, that could affect lending and the broader economy. So the system must be carefully designed to prevent that scenario.
To address these risks, strict design limits are built into the system. One key measure is limiting how much digital euro each person can hold. Another is that the digital euro would not pay interest like bank deposits.
This reduces the incentives to move large amounts of money away from banks.
The goal is to make it useful for payments, but not attractive for storage.
This project is no longer theoretical, it is already moving into real development.
Technical systems are being built, tested, and refined in controlled environments.
Pilot programs are expected to involve real users and financial institutions.
A full rollout could happen later in the decade if approvals are secured.
But at this stage, no final decision to launch has been officially made. Even without a final launch, the direction of change is already clear.
Money is becoming fully digital, whether we actively notice it or not.
And systems are being built now to define how that future will operate.
So the real question is not whether digital money will exist, but who will ultimately control it
when the system is fully in place.